What up, what up, what up? It's your boy, the Options Boss, sliding up on y'all. So, guys, I hope y'all had a great day yesterday and we're getting ready for another great one today. But listen, guys, I got some big news for y'all. Yesterday, your boy hit 400 subscribers for the first time. Thank you all for who all support the channel, watch the videos, especially you who watch the videos countless times. I definitely appreciate you. And now what I'm doing is I am doing a march to 500 subscribers. And what I'm going to be doing throughout this time is every video I make and every video I've already made, if you comment down below on any of those videos and say, I'm a subscriber and I want in, I am going to enter you guys all into a raffle for a free share of tea that I'm going to be giving away when I hit that 500th subscriber. Now, what's going to happen is you'll comment down below, I'll write down your YouTube name, and when I make my first video after getting my 500th subscriber, I will do a raffle on that video where I'll pull a name out of a bag or a hat or something like that. And whatever name I pull out, if that person comments on that video, I'm going to gift that person one free share of tea. I like tea because it's a dividend stock and it does have a little bit of ability to grow. So I think it's a very nice stock and it'll be my way of thanking you guys for supporting the channel. So if you have not already subscribed and hit the notification bell, definitely subscribe now. Definitely hit the notification bell. And it's not too late for you to get in on this raffle. And guys, if you're already a subscriber and you're already checking out my videos constantly, definitely comment down below. And like I said, every video you guys comment on will qualify you to enter the raffle. So you definitely want to get in. Now, with that being said, guys, we're going to move on today to something very important. Very basic, but very important. I'm going to show you guys today how to buy a call option, and I'm going to show you how to buy a call option on Robinhood and on Webull. Both apps are apps that's used prominently today, and I want to make sure you guys know how to buy calls because buying calls is a great way to supplement your portfolio and to make a lot of money in a short time with a little bit of risk if done properly. So that's what we're going to go over today, guys. Now, as you all know, I prefer Webull over Robinhood. So I'm going to leave a link down below to my Webull account. And if you guys sign up for my Webull account through my link, you will get an account of your own, of course, and you'll get 2 free stocks as soon as you deposit $100. So what will happen is you'll have access to trading at 4 a.m. Eastern Standard Time all the way to 8 p.m. Eastern Standard Time. So you're trading all day, which is great for a trader like me because I love to trade. And at the same time, you're going to get 2 free stocks as a gift. So guys, it's a great opportunity. And if you don't have Webull, I definitely suggest you click that link down below and sign up. That being the case, guys, you already know how we do. We're going right into Robinhood right now. All right, guys, so here we are. We're over here in my Robinhood. And I'm going to scroll down and I'm going to find a company for us to practice trading a call on. I see NEPT, but we're going to skip them, get something a little more liquid. And let's see, what do we have here? 2 very liquid stocks. We'll start with Tesla. So guys, right now, we clicked on Tesla, and we see that in the pre-market, Tesla is trading at 674.20. And that's fine. So we'll click on trade. On the very bottom right, you'll click on trade options, and you'll get to this screen where it says discover. And at the very top, you'll see the dates that we have to click on for an option call, which would be March 26th, April 1st, April 9th, April 16th, so forth and so forth. These are all the things you could do: buy a call, sell a covered put, debit spread, put credit spread, etc. We are going to buy a call, and because we're going to do that, and it's just generically on a call, we're going to click on the date, and for now, because it's just for video purposes, we'll say March 26th. Now, when you get to March 26th, at the very top, you'll see buy and sell, and you'll see call and put. So what we're going to do, guys, is we're going to make sure buy is clicked on, which it is. It's highlighted. We'll make sure call is highlighted, which it is. And then we will start looking at the Tesla call options. So, guys, to buy a call, there are things you have to consider, such as we are in pre-market, so the stock price is moving. Right now, it's at 673.86. So if I buy a call that is less than that 673.86, that call will be considered an in the money call, guys. So let's say, for example, I wanted to buy a 670 Tesla call. That call would cost me 20 cents, $20.48 per contract. And we know each contract has 100 shares of the company that it's responsible for. So the stock price, the option price would be $20.48 times 100. And that would give us $2,048 as a share. So if we were to buy one option, it would be $2,048. Now, guys, this Tesla call 670 is less than the price that the option is trading at now, which is $673.86. So this is called an in the money call. Now, when you buy an in the money call, the in the money call is going to be more expensive. And as you look at the right-hand side of the screen, if you look at the other call options, the higher up I go in price, the lower the call option becomes. For example, this 690 call is only worth $11.73, which would be $1,173. Now, the reason that's the case is because the further in the money you are, the better your delta is going to be, the better your gamma is going to be, the less your theta is going to be. And guys, if you're not familiar with those terms, I did do a video on the Greeks that you guys should check out, but we'll get to that in a second. But like I said, guys, if you were to look at this 670 call, so we'll click on it. And as you see, where it says limit price, it says 1 for 2048. So if you hit 1 on it, you will see, like I said, you were paying $2,048 for one contract. If you wanted multiple contracts, then you could hit the 2 or the 3 or the 4 or however many contracts you're buying. But one thing I like to do when I buy a call option is I like to click on a limit and bid. And the reason why I do that is because it gives you all the stats of the company. So these stats are going to change once the market actually opens based off of if Tesla's price is higher or lower than yesterday's. But when I get to this area, I go past the stats. I skim past the stats. A couple of the things I look for is the bid and the ask price. And that's very important because what I like to do is I like to get in somewhere between the bid and the ask. And basically on Robinhood, that's called the mark. And the mark for this particular option is $20.48. So if I were to try to buy this, I would try to buy it at that price. Now, there's some people who would try to buy it less than a price, and that's called the bid, and that would be $20. So somebody is trying to pay $2,000 flat for this option. Now, what happens is if you buy this option, or you try to buy this option at $2,000, it's not going to get filled immediately. It's not going to get filled until Tesla's stock price fall enough to make the value of this contract come to $2,000. So it could get filled if you go to the bid, it could not. Likewise, if you go to the ask, the stock price, the option price for the ask is $20.95 if you look at the right-hand side. Now, if you go to the ask, you're going to get filled immediately, but you're going to come into the contract already losing almost $50, $47 to be exact, because the contract is worth $20.48, but you were willing to pay $20.95. So that's why I always try to go to the mark, as it's called on Robinhood. And if I have to go a little above, if I want to get in immediately, I'll go $1 or $2 above the mark just to make sure the contract is filled immediately. But I almost never go to the ask. I did say almost never because it's sometimes, depending on how a stock is moving, if it's moving fast and you want to get in, pretty urgently, you may have to go to the ask to ensure you get in. But when I go to the ask, I try to go to the ask on a stock that's going to keep moving strongly, because if you go to an ask and the stock doesn't move strongly, you're basically setting yourself up for a losing trade. So you want to definitely look at the bid, the ask, and the mark if you're trading an option on Robinhood, guys. Also, it's good to look at open interest. It's good to look at volume. These things all dictate how valuable your contract will be. If the contract doesn't have a lot of volume, if the contract does not have a good amount of open interest, then it's going to be hard to sell it because there's not going to be a lot of buyers looking to buy. So you always want to make sure volume and open interest is there on the option that you're buying. Now, the good part, what I like to look at, guys, is I always like to look at the Greeks. So you'll see the delta, you'll see the theta, you'll see rho, you'll see gamma, and you'll see vega. Now, I won't explain what those things mean. Just know that they're very important. If you do want to know what the Greeks mean, and like I said, it's very important, I am going to link a video to the Greeks, and I'm going to link that video right up top so you guys can click on that video when you're done watching this, and you'll have an understanding of exactly what the Greeks mean and how it affects you when you're trading. Now, guys, that being the case, we're going to move out of this call. That was the 670 call for 326. Now, like I said, if we were to get an option that costs more than a share price, which now is at 675, if we were to get one that costs more, that would be considered an out the money contract. Now, we'll look at, let's say, the 685 contract. That's considered out the money. That one's trading at 1325, which we know, because it's 100 shares, that will be $1,325. So, guys, we'll click on that. And again, you put in your contract, it'll show how many contracts you're getting, and it'll show the max cost at the bottom. And again, I would click on the limit price. I will look at the bid, the ask, and the mark, and you see how it is different and it's less costly than the contract that's in the money. And like I said, guys, it's less costly because the contracts that's in the money are more valuable. And if you buy a contract that's out the money, once it becomes in the money, it becomes more valuable than when you initially bought the contract. And again, scroll down, I check out delta, gamma, theta, vega, and rho, and just basically see what's going on with those particular Greeks. So, guys, what I want you to realize is this changes all the time based off the share price. These prices will fluctuate. And in a best case scenario, what you do is you'll catch a stock when it's about to make a big move up, and you'll buy options at that point in the best case scenario. And these are things that you need to have in your mental Rolodex, so to speak, because buying shares is great and trading shares is great. But the way that you make a lot of money in a short span is definitely buying options. And if you can buy options on Robinhood and your account is built, your portfolio is built on Robinhood, you have a great chance of making yourself a lot of money. Even on red days, you'll find a company here or there that you know is going up, and if you buy a call on that company, you'll make some money. And even at the extent you could buy a call on a red day on a company that's going down, and your premium, the amount of money you spend all the way on the right, will be less money. So let's say today is a red day, which I hope it's not, but if it is, if today's a red day and this Tesla 670 call costs $20.48 right now, by the time, you know, the redness kicks in and Tesla takes a bit of a hit, you might be able to buy this same exact call for $17.50. And now you get in the same position and you save $350. So that's definitely something to look at. Now, guys, also keep in mind, the further away you go, I'll click on April 1st, the further away you go, the more expensive the calls will be. And the reason being is because you have more time to hit the expiration price, the strike price, that you're looking for by expiration. So when you get these calls, always keep in mind your expiration date, because that's going to decide when you have to make a move at worst. Now, that does not mean you have to hold the contract to expiration, because, guys, you should always have a plan when you get in your trade. And when I say a plan, I mean you should have an amount of money that you're willing to lose in this trade, and amount of money that you're hoping to gain in this trade. So again, just because I'm right here, let's look at this 677.50 call. It costs $36.95. So I could get in this trade and I would not necessarily be willing to lose $36.95. I might say, hey, I'm willing to lose $500. So what that means is if the value of this contract goes down to $31.95, at that point I lost $500. At that point, you stick to your plan and you get out the trade. You do not sit around and wait for it to come back or anything like that, because what happens is it may not come back. It may go down worse, and then you'll lose more than the $500. You'll lose $1,000 or $1,500 or whatever the case may be. So you never want to do that. When you have a plan, it's very, very, very important to stick to the plan. And on the flip side, this contract cost me $36.95. The value of this contract could, almost double. And let's say now it's worth $70.95. All right, well, now I made almost 100%. So maybe at that point, I need to get out. Now, you could stay in the contract because you got time on the expiration and say, hey, maybe it's going to go up further. And that's fine, but that's called greed. Once you have an idea of how much you want to make and you hit that profit, get out. Because, they say bears eat, they say bulls eat, but they say pigs get slaughtered. So I do not want you guys watching this video to be a pig. Once you see you hit the price that you were hoping to hit, take your profit and get out, even if it's time on expiration. If you feel strongly about the position, you could always take profit here. Let's say this went up to 70, like I said. You could take profit here and then come back and hop into, say, the 692. Now you're still in, so you still got exposure, but you're spending less money. And that way, you done already took some profit off the board and you done built your portfolio. So that's what I want you guys to do when we're trading options on Robinhood. That's what I want you to do when we're trading options on Webull. And because I brought up Webull, I'm going to take you guys over there right now and I'll show you exactly how the options chain on Webull. All right, guys. So now we're over here on Webull, and I'm going to show you guys how the trade chain would look on Webull if we were trading a call option. So I'll just click on any random company. AAL is at the top of my list. We'll click on AAL. So once we get here, guys, you'll go down to the very bottom. You'll see trade, positions, options, comments, and more. Also, keep in mind at the very top, in the pre-market right now, AAL is trading at $23.28. If you see that price right underneath the highlighted white bold print. So that's where it's at right now, $23.26. You'll click on options down below, and up comes the options chain for Webull, and you can see how it's different than the options chain on Robinhood. Now, that being the case, at the very top, you see the date, which is March 26, 2021. And you could click on that. And like I said, with Robinhood, where you have the ability to change the date, and the further out the date will be, the more expensive it will be. And you can click on any one of these. Because we're just making a video for practice purposes, I'm just going to leave it on March 26. Now, at the very bottom, you'll see it says single option, both calls and puts. Now, because we're doing calls in this video, we're going to leave it on calls, which you see calls is highlighted. And we'll begin to look at several factors of this option. So, again, if we purchase anything below the 23.83, which is showing right here, that will be considered an in the money call. So if we bought 23.50 call or anything lower than that, that will be considered an in the money call. And the reason why is because the stock then already went past that price point. Now, again, in the money calls are always more valuable and more expensive on a ticker than out the money calls. If we got a $24 call or anything higher, that would be considered out the money. And in that instance, we will pay less money and we will have less value on those particular options. Now, guys, what I want you to look at with this, we'll look at, let's say, the $22 call. And you look at several factors. So again, you look at the bid, which you see at the very top. You look at the ask. And you like to look at the mid if you skip over a couple categories. And it's the same. The mid on Webull is the same as the mark on Robinhood. So it's that happy point right in the middle where that's where you want to bid at, and it'll get you in right where the contract is valuable. If you go to the bid, you'll have to wait to get your option filled, and it may or may not get filled. If you go to the ask, you're going to come into the trade already losing, which is not necessarily the best idea. And the only way I could really recommend it is if you just feel very strongly that this stock is going to run. And if you don't get in now, you're going to fall behind. So if we were looking at the 22 strike, we see the bid is 187. We see the ask is 197. And the mid is 192. So if I wanted to get in on this particular position, I would bid 192 or maybe $1 above 193 to make sure I get filled immediately. Now, if you scroll over, unlike Robinhood, you don't necessarily got to click on it. You'll see the implied volatility, the open interest, the delta, the gamma, and the theta, which are always very big things that you want to keep up with. So that being the case, guys, like I said, the more in the money you get, you'll see the theta becomes less and less. The theta being the very last column all the way on the right. The further in the money you are, the less of a factor theta becomes for your contract. And the more in the money you are, the better off you'll be in essence with your delta. So that's always what you want to keep in mind. You'll get bigger delta. Now gamma, it'll have a point where it tops out, where it's at its absolute highest, and then it'll kind of get lower. And the reason why the gamma gets lower is because it's already making big moves based off the based off the delta. So it's only but so much bigger of a move it can make. As you see, the highest delta here is 0.99 on the $19 call, and the gamma is almost non-existent. And like I said, it's because it's already making a 0.99 move, so it's hard to make a bigger move than that on a stock such as AAL. But again, not going to elaborate too much on the Greeks. I do want you guys to click on the video to watch the Greeks, however, so please make sure you do that by the time you're done this video. That being the case, guys, if I were to click on this 22 call, you will see at the bottom it says long call, both, and it says calls and it says puts. We got it selected on calls. We got it on long call. At that point, it shows underneath what we will be purchasing, which is a $22 call for March 26th. It says call, it says buy, and it shows us the amount of contracts we will be purchasing all the way to the right, which is 1. So hypothetically, if we wanted to add more, you could hit that little plus sign. If you wanted to take away some, you could hit the minus sign. And if you like what you see, you hit edit. When you hit edit, this is the screen where you would be buying off of. Again, it says long call, it says buy, it says call, shows you the expiration date, the strike price. It shows you that it's a limit order and how much you will be paying at the limit price. And like I said, guys, I always try to hit the mid. So where you see that at, you'll always see a bid, a mid, and an ask. And I would just adjust to the mid price to get in. And if I wanted to get in, like I said, a little more urgently, I would go a little over the mid price. And once you did that, you hit buy. And once you hit buy, you will basically have the opportunity to buy whatever option you were looking to buy. And it's the same exact thing if you go out the money, same exact process. The further out the money you get, what you're going to notice is the delta gets lower. And the delta gets lower because it takes a bigger move to make the particular option move because you're so far out the money. So that's something to keep in mind. There's nothing wrong with going out the money, but when you go out the money, you better be expecting a huge move, because if you go out the money and a stock only makes a small move, you're just going to lose money based off of theta, and that's not going to be good for anybody involved. So that's essentially what you want to do. I hope you guys are enjoying this content. Like I said, my March to 500 is on, and with that March to 500, you guys comment below and say I'm a subscriber and I want in, and I will qualify you guys for my giveaway of the company T. And it's a dividend stock, so you guys will definitely get every 3-month reminder of you being a subscriber to this channel. And I hope you guys enjoy it. So make sure you subscribe so you can qualify. Make sure you hit the notification bell. Don't forget, you can always be a boss with the options boss. And I'm a holler when I holler.